Now I want to introduce our trainer today. Joseph Jaramillo is a senior attorney at Housing and Economic Rights Advocates in Oakland. He has over 20 years of experience in public interest law, and his practice entails direct services, litigation, and community education on consumer debt and credit issues affecting low to moderate income individuals. He counsels and assists homeowners on preventing foreclosure and modifying their home loans. He also counsels and assists pro se litigants in debt collection, defense case, and sometimes represents them in court. Yay. He provides advice and education on credit repair issues as well. So thank you so much, Joe, for being here today. I will go ahead and monitor the chat. And I know that you have a couple of times during the presentation when we will be accepting questions, and people, you can put them in the chat. And if they're too specific or detailed that we may not be able to get to, we will make sure you have information about how to get in touch with Joe at HERA. Joe, thank you so much. Take it away.
Thank you, Beth, and thank you, Leah. I'm really happy to be here with you on this kind of nerve-wracking and exciting day as we see the election results roll in. I'm going to go ahead and share my screen now. And we're going to talk today about safe and affordable banking with the background also in credit and basic budgeting, because I think those go hand in hand with this issue. And I hope that this presentation will really provide some good background material and orientation on some issues that your clients might be facing. The PowerPoint actually is designed not just to allow me to present information to you, but I hope it will be useful as a resource that you could draw upon. There are some things that you could show clients, or you can adapt, and it gives you some good pointers on other places to find useful information. Let me go to the next screen. So, this sort of a starting place in helping people with financial wellness is just to make sure they understand the basics about their own budget and their household spending and expenses and income. It probably goes without saying for everybody, but a budget, just to nail it down, is where you write down and decide how you're going to spend the money that you have each month. And it can help you track your expenses and plan for your future goals by being able to allocate funds for the necessities and see what's left over to save, hopefully, and make sure that you're prioritizing the things that are most important and cutting back on things that might not be as important so that it can allow you to achieve your goals. And obviously, you want your expenses to be as much as your income, or not more than your income, hopefully less than your income, but you don't want to be going in the negative, because that's not useful. One thing that's useful for clients is to have them do a current and a revised monthly spending plan. Apologize for the typo there. It's not monthly, but monthly spending plan. And you basically want to you start out with your monthly take-home pay on top, and then you subtract all the things that you're spending on. And it's good to do a current snapshot to see where you're at now, what your monthly take-home is, and what your expenses are, and what's left over to spend. What is their remaining balance, and to then kind of do, in a perfect world, this is how we would revise it. This is how we would want to make adjustments. You have to pay your rent and your mortgage to stay housed. You have to pay your utilities and food and transportation, but can you cut back on things like clothing, entertainment, gifts and contributions? Is it a time to make just the minimum monthly credit card payment as opposed to trying to pay off the whole balance? And any miscellaneous expenses. So I find this to be a useful tool. It's something you could use with clients or yourself. The Federal Trade Commission has a good website. If you just Google Federal Trade Commission and monthly spending plan or budgeting. They actually have a different format for this that is, I find to be quite useful. Sorry, I didn't mean to go to the next page, but I will go now. And so, one key thing is to try to prioritize the bills and weigh the risk of not paying certain bills right now and seeing if there are things you could put off until later or make minimum payments so that you don't incur any huge risks on things that carry risks, like not paying your rent or not paying, utilities, which are all necessary. So this kind of, gives you another tool. This is adapted from the Consumer Financial Protection Bureau, another federal agency that has some very useful information on its website for consumers. But you want to figure out the expenses that you need to pay now. That's kind of at the heart, at the center of it, and then you kind of work your way back to the things that that you can that you might not need to pay at this point, or that you could cut down on the discretionary spending. So just another tool to use in making those kind of planning decisions. Okay, I'm going to switch now to just talking about bank accounts. I think a lot of this is probably basic for most of you, but it's good, with clients, you're not sure what their level of sophistication is when it comes to banking, and you want to be able to start with the basics, start from the basics for them, and kind of just break down, what is a checking account. When we talk about bank accounts, we usually mean checking accounts, and that's where you can keep your money in the bank and you could spend it easily because you can write checks or you could use the ATM card. It's a safe, easy way to store your cash. But one thing that it pays to look more closely into the different banks and what they offer is that most checking accounts do have minimum balance requirements, and they can charge you overdraft fees if you withdraw more money than you actually have. If you only have $20 and you write a check for $50 and you've agreed to overdraft protection, the bank will pay that $50 check, but then you're negative 30 plus an overdraft fee that could be 25 to 50 bucks on top of that. So it's something to pay attention to. Some banks have different policies. Some banks kind of give you a grace, not a grace period, but sort of a cushion where they will cover the overdraft without charging a fee as long as you bring your account back over zero within a certain amount of time. So these are things kind of to look out for when you're shopping around for if you want to change banks or get a checking account. A savings account is more geared towards savings. Banks usually pay interest on the money that you keep in your savings account. There's a wide variety of the interest that you can earn right now. Unfortunately, interest rates are low, which is good for getting credit, but not as good for earning money with the savings that you keep in your account. But there is a wide variation among banks. A lot of the online banks tend to offer higher interest rates so that you can grow your savings better with those. And whereas sort of your brick and mortar banks tend to offer pretty low, below 1%, very low interest rates, and that's not as good for growing your money. You have to be careful with savings accounts. You have to look at the terms of what is being offered, because although it does allow you to save your money and even earn interest on it and keep it safe in the bank, you can face penalties for withdrawing money too often from a savings account, depending on the terms of the bank that you're working with. Because the benefit to banks of savings accounts is that they have all that money, and they can, you're basically letting them, your money's there and it's safe, but you're letting the bank kind of use that money for other things. And so they don't want you to be taking it out, frequently. Just some basic things on what you need to open a bank account. Obviously, you need to deposit money. You need to have a government issued ID. You need to have a social security number. or an ITIN, a taxpayer identification number, which undocumented immigrants will have. Usually they can get that to allow them to pay taxes and have their income reported. And you need that for an interest-bearing account because that the interest that you earn does get reported to the IRS. And the bank system report, that's not something that you or your clients need to have to open an account, but it exists. It's like it exists, and it's like a credit report. And it could be a useful tool if you or your clients have ever been denied for a bank account. You can pull your bank system report from the checks system, and here is the link there that you can go to, and you can basically get a free report from them if you've been denied a bank account, and it basically shows you your banking history, not your credit history. Kind of have to distinguish between credit and checking and savings. Credit is money that it's not yours and you borrow it to use it, and you have to pay it back with interest if you don't make timely payments. Whereas bank accounts, that's your money. It's not going to show up on your credit report, but it will show up on this checks system report. And so it's something that a lot of people don't know about, but it's something that can be checked for people that are having problems with getting a bank account. There may be an issue there. There may be an error and inaccuracy, that's not, that doesn't, maybe something that you can correct because it's wrong, and maybe that'll allow you to get better access to bank accounts. I didn't mention this in the beginning, but I do plan to open up to answer some questions probably around midway in the presentation and then at the end. And I just request that the question be general in nature. If there are more personal type questions, we wouldn't have time to get into that information in detail. But we can certainly, you can, let us know in the chat or by email, and it's something that we could probably talk offline about.
And I'll be tracking those chat questions, Joe.
Great. Thanks, Beth. So, here's some general questions to ask before opening a bank account. You want to know if there's a minimum balance requirement to avoid a monthly fee, and what is it? And does that make sense with the amount of money you plan on, having in your bank account? A lot of people have their paychecks automatically deposited, and so sometimes that is enough so that you will not incur a monthly fee. How soon is the money available after you deposit it? Banks and credit unions have different policies about that. And if you're kind of on a tight schedule between, when your money's deposited, your paycheck, and when you have to pay your rent or your bills, you want to know that so you don't get caught, in limbo while you're waiting for the money to clear. Some banks have policies about whether you need to open a checking account to have a savings account. So you want to look into that. Is there a limit on the number of withdrawals you can make each month from your savings account? What fees are associated with the account? You don't want to get caught off guard with those fees that will, make your balance go further down than you anticipate. Are there fees associated with debit cards that you get from the institution? Is there online banking, which has been very useful? In the past decade, people can pay their bills from the internet, and it makes it a lot easier to manage your finances that way. And are there fees associated with ATM withdrawals? And if you plan to use ATM withdrawals or in-person withdrawals, is the bank or the credit union easily accessible to you? You don't want to be in a situation where you live in one place and your bank is, across the bay or something. I'm going to kind of switch gears and move on to debts. Now that we've covered banking. So one thing we try to counsel people on is avoiding debt traps. It's basically a debt trap is where you get an emergency cash loan or some kind of assistance. But because of the terms of that loan, or the interest rate or fees that are associated with it, you're kind of in a downward spiral where you got to get another type of loan to pay off that loan, and you can never get out of that debt. Payday loans are a big example of that because they have short repayment periods and high cost fees. Deposit advance loans and tax advance loans are other examples. Auto title loans. These kind of loans are not good generally, and if there's a way to avoid them, that's what we recommend. Sometimes it appears to be the only option for folks, but we'll kind of try to point you to some other options, or your clients to other options later in the presentation. So kind of the best way to go through the options is to take the example. You have an emergency expense, whether it's a medical bill or you need to get money to pay your rent or whatever it is. You need $300. What are your different options? This is kind of a laundry list of the different options that we've identified in this situation, and we'll kind of go through each one and see what the pros and cons are of each of them. Payday loans, like I said before, they're not a good deal. They just charge a lot of fees. They require you to pay them back really quickly. And it leaves borrowers kind of hanging in the lurch. There was a study by the Consumer Financial Protection Bureau that found that 80% of borrowers that take out payday loans then take out another loan within 2 weeks of repayment, basically to pay off that payday loan. So it's kind of the debt trap that we were talking about. They're not price competitive. The lenders will charge as maximum allowable fees and high interest rates. And it basically leaves people scrambling to pay them off, and then they have to take out a loan and pay out that loan. All right, have a little, let me just see what's going on here. I keep getting this little window here appearing in the middle.
Yeah,
so,
we're seeing it too and wonder what that is. I've never seen that before. It's strange.
Yeah, I don't know, but hopefully it'll go away.
It's kind of fading in and out.
Yeah, so sorry for that, folks. I'm not sure quite what's going on, but we'll try to work around it. So these are kind of the big payday loan companies. Check and go, cash call. They try to lure you in with, being able to give you quick cash until your payday comes around, and then you pay them back. But they don't really tell you about all the fees and high interest rates associated with them, until you're actually there getting the payday loan. So there are regulations and laws that do restrict how much payday lenders can charge you. The maximum loan amount's $300. The maximum fee is 15%. But think about it: if you have to pay a $300 loan back in 2 weeks at 15%, if you convert that to an annual percentage rate, that's 460%. So it's a huge amount, really. One thing to know is some people worry about the consequences if they're not able to pay back payday loan. They cannot bring criminal charges against you. All debt collection matters are handled in civil court. So that's, I think a lot of people worry about the criminal consequences. There aren't criminal consequences, but there can be some pretty dramatic financial consequences. And the payday lenders are not always above board. They may make false threats about the consequences. They may charge you more than they're allowed to, and you can complain about this to the Consumer Financial Protection Bureau. There's a link. In the copy of the PowerPoints, I think that was sent out to you, this information here about the California Department of Financial Protection and Innovation may be a little different. They used to be called the Department of Business Oversight. They recently changed their name and got some legislation that made them a lot more of a stronger enforcement agency. But the phone number is the same. I did put a new link on how to file a complaint because that information did change. So just note that what you received in the copy of my PowerPoint is, again, this might be different, or it is different, but this is the updated information. And if you just Google complaint and DBO, you'll come up with this link regardless. So if you see here at the bottom, we'll talk about this more later, but this is the Truth in Lending Act, or TILA box. And any consumer loan, or most consumer loans, have to show this because it allows consumers to understand what the true cost is of their loan. It has to show the annual percentage rate and what that converts into in terms of a finance charge, and the amount that that you're being financed, and then the total amount of payments that you'll make. So you can see that if you're getting a $255 loan, you're going to pay $45 to get that, and your total payments will be $300. So it's kind of useful so that people, they don't, they understand the true cost of the credit that they're getting. There are companies, advertising is Payday Alternatives, and the Consumer Financial Protection Bureau has found, LendUp was one example where they investigated and found that their lender was really misrepresenting its product in terms of helping people build credit or access cheaper loans, and engaging in false advertising, and not reporting information to the credit bureau as part of, when you're trying to build your credit, you want good information to be reported to the credit bureaus that shows that you're making your timely monthly payments, and they weren't doing that. And so you have to be aware of the, now with high tech and online products being offered all over the place, you really have to do your homework before you get into that kind of arrangement, because you just don't know if they're going to really follow through with what they're offering. We at HERA, we try to help people vet these types of loans and financing. If they get to us, they come to us before they actually sign anything or agree to anything, and we can help people research them. There's a lot of stuff online you could look, like check out the Better Business Bureau rating, or go on the Consumer Financial Protection Bureau website and see if they've been investigated, or if they've been fined or subject to an enforcement action. Okay, so payday loans, bottom line, it's not a good option. It's to be avoided if possible. The next option we'll look at is a personal loan. So let me just try to move this. I don't think I can move that thing there. Sorry about that. So personal loan, there are small dollar lenders that try to get people to take out loans. And traditionally, they try to get you to take out a loan that was $2,500 or more. And that was because there is a finance lender law before 2020. It had interest rate caps on the amount of interest that could be charged if the loan was less than $2,500. But they did not have interest rate caps on loans that are over $2,500. So you would have consumers, maybe they only wanted a $1,000 loan for whatever reason. And the small dollar lender would push them, well, why don't you take out $2,500 or more? And the reason why is because they wanted to slap on the additional interest. We saw interest rates of 100% or more on those kind of loans. So on January 1st, 2020, a new law took effect in the financial code that actually did put an interest rate cap on loans between $2,500 and $5,000. And so the interest rate cap is not a set percentage, but it's tied to certain government indexes, and then it can only be a certain amount of percentage above that. But generally, what they're hovering around right now, if you do the math and figure out the interest rate cap, it's about 45%. So a lot better than 100%, but still not ideal. These small dollar lenders can really charge a lot of interest on these loans. So personal loans, not the best option either. You know, with a high interest rate, you might be in that same debt trap cycle where you get the money to pay your loan, your rent and your expenses in 1 month, but you're then scrambling to pay off that loan. Overdraft, you know, we don't think of it traditionally as an option to get $300, but there is a way to, if you're careful and kind of read through the fine print, there is a way with some bank accounts that overdraft can be used strategically, actually, to help you get some emergency cash and then just pay the overdraft fee. So overdraft, you know, is basically when you spend more money than you have in your account. You might only have $100 in your account, and you buy $124 worth of groceries, and your debit card goes through, and it pays that extra $24 that you don't have, but then it charges you an overdraft fee of $35. You know, most overdraft transactions are only just $24 more than what is in the bank account, but the most big banks will actually charge you $35 for overdrafting. And there can be limits on how many overdrafts you can do before the bank just doesn't pay out your ATM or check. Usually 4 overdrafts per day. So the issue kind of here is, do you even want to have overdraft protection, knowing that it's going to put you more in debt to the bank because of the overdraft fees? And most consumers, in a survey by the Pew Charitable Trust, said that they would prefer to have their transaction decline rather than incurring that fee. So going back to basic banking, you know, one thing to really look out for is, do you even want to have that protection, knowing that it could increase your debt to the bank? And you know, it's also sort of a big industry for banks because the overdraft fees, you know, in one report showed that the banks made $24 billion in overdraft fees, I think, for that year. But key thing for consumers is that consumers have to give their affirmative consent to charge overdraft fees, and they have to provide written notice of it. And consumers have the right to cancel that protection at any time. So if somebody's running up against a lot of overdraft and getting charged a lot of fees, they probably should consider canceling that protection. And there, you know, I keep talking about the Consumer Financial Protection Bureau. They accept complaints when there are abuses with unfair overdraft charges, and they have taken action against banks for doing that. And this is one example where TCF National Bank tricked consumers into a costly overdraft fee service. Not going to go into details on this particular case just because there's a lot of material to go through, but you have this in your copy of the PowerPoint, so you can read further about it. So here's what I was talking about in terms of using overdraft strategically to basically use it as a personal loan. It can be used when you know that you don't have the money to cover a transaction that you need to make. You should know how much the bank is going to charge you, so you could plan for that as well, because that's sort of the finance charge that you're paying to use that money. And you know, it's best used when you only need to make one large transaction. You know, it's no sense in spending and using overdraft to pay something that costs $20 when you're going to get charged $35 for that. But if you're going to pay something that's $255 or greater, then the proportion of that $35 charge is less, and so it kind of lowers the interest, so to speak, on what you're paying for that transaction. And it's also, you don't want to just rely on overdraft. You want to look at other alternatives. Maybe you find a personal loan that's at a really good interest rate, 6% or less, and that's going to be more advantageous than paying the $35 on the transaction that you're looking at. So as it says at the bottom, a strategic overdrafting might be cheaper way to pay, cheaper than a payday loan. Where payday loan, the max is $300. So you're basically getting $255 because you have to pay the $35 interest to the lender. But if you have a transaction greater than $255, overdraft would be the way to go instead of a payday loan. On the other hand, if you're trying to prevent overdraft fees, like I said before, the service can always be canceled or revoked. Don't use your ATM or debit card to take out money or make a purchase when you don't have enough funds to do that. Ask your bank if instead of charging overdraft, can they link your checking account to your savings account so that any money that's not sufficient to cover checking can be taken out of the savings account. And then, as I mentioned before, when there are abuses, you can make a complaint with the Consumer Financial Protection Bureau. Another option is a credit card when you need the $300. It's a convenient form of borrowing money. It does require a minimum payment each month, and make the distinction for consumers that don't have good credit. There are secured cards available if you don't have good credit that usually require a collateral or deposit to the bank that can be used. You're basically borrowing from that, and it allows you to get a credit card with even if you have negative credit history. Whereas an unsecured card does not require any collateral or deposit, but you do need good credit history to get an unsecured, what we think of as just your regular run-of-the-mill credit card. A little more detail on a secured credit card. Many consumers don't know about this. Their credit is bad and they feel there's no way they can get a credit card because of that. But it is possible. Like I said, you have to deposit a one-time fee in collateral that's usually between $200 and $500 to the bank, and that deposit will stay in the bank for about 6 to 12 months. And then you can use the secured credit card, which works like a normal credit card, but your credit line is your deposit. Basically, you're kind of spending your own money, and that's a way to show the bank that you're a responsible borrower. And after 6 to 12 months, depending on the term of the credit card, if you've made timely payments, you haven't spent more than, or tried to spend more than is in the deposit, then that deposit is released back to you and you have just a normal credit card. And so the key to that is, in using the secured credit card, is try not to make purchases that are more than 30% of your credit line. So if you deposit $500, then you don't want to spend more than 30% of that, and try to pay off your full credit balance each month. So in many cases, this is not sort of the solution to get money to pay off some big expenses. It's really more of a credit building strategy, so that after the 6 to 12 months sort of probationary period, if you will, you get your money back that you deposited, and now you have a credit card that you can use like a regular credit card. So this is something that a lot of our clients don't know about. that can be useful to them. All right. Some other options here, and then we'll take a break for questions. So these are kind of less common or available options for people, but there is a financial product, if you will, called a lending circle. This kind of evolved from informal practices from people from different cultures, but basically it's a group of people that get together and everybody pitches in money to the lending circle. And then at certain periods in time, certain members of the circle are allowed to use that money for their household needs. And it's actually been organized into a financial product by the Mission Asset Fund in San Francisco. And so that's the one that I know for sure offers that, I believe, is that organization. But it's an alternative that can be used for people that otherwise can't get credit, maybe, to start a business or to pay for an emergency household expense. Then, of course, there are things that you can't really, a lot of people just can't count on, but you can borrow money from family or friends. Some workplaces offer loans. If you have a 401k or 403b retirement plans, you can take loans from that, and then from your own savings. So these are just other strategies that we talk to clients, and obviously saving for a rainy day is something that not all of us could do, but that's where the budgeting comes in the beginning of the presentation. The strategies and planning tools that we talked about for budgeting. So this is about halfway through the presentation. I'd like to pause and address or try to answer any questions that folks have.
Yeah, there was a question, Joe, that came in earlier about why someone would be denied opening an account. So that was one, like a checking account or a savings account.
Yes. So, I guess it's not something we hear about too often, but there are folks who might have had a checking account in the past and they overdrafted, or they bounced a number of checks, and eventually the bank, and they incurred a number of fees from the bank, and eventually the bank decided to close their account. Well, that gets reported to the checks reporting system that I talked about. And so when that person then goes back and tries to open another bank account later, the bank that they're applying to will see that on the report, and that they could use that as a basis to deny them an opening up a new bank account, or they might give them more unfavorable terms to the banking account. So that's sort of, it's a banking history that banks have access to, and consumers have access to as well, that most don't know about it. But that is a reason why someone could be denied opening a bank account.
And is there some other kind of account, like the one you described earlier, where you put your own money in the account, that might be available to someone who's denied a traditional account, or is there some other options?
So one option might be is just going to different banks. One thing I didn't mention is credit unions tend to be more consumer friendly and more open to people that might not have as good a banking or credit history. A credit union is an organization that's a nonprofit. So unlike most banks, they're not trying to make a profit. Their mission is to help their members. You do have to pay a membership fee to join, and you have to apply and be accepted. But they tend to be more open to folks who might not be able to get a regular bank account, because of their nonprofit mission. So that's one alternative. The lending circle that I talked about might be another alternative. Those are the two things that come to mind at this point.
Yeah, I know years ago, I was able to join a credit union through my mother, who was a teacher in the California Teachers Association, and still a member of that. So there could be interesting for people to check in in with any of their, the kinds of organizations that they're part of that might have an affiliation with a credit union. I don't know if that still happens, but that's how I got involved in one. And then
That's a good point, Beth, and that there are definitely credit unions that are associated with the military or with federal employees, with teachers, and that does still exist. So that is something to look into.
Right. And then there's a question about, are there specific products for that caregivers could use to train a young adult to establish themselves and to teach them about banking literacy? That's a great question.
That is a great question. I'm sure there are things out there. I can't point you to like one specific organization or course. I mean, we certainly, HERA would be interested in trying to assist with that or even look into it further. We can give a similar presentation targeted to caregivers. We have in the past dealing with certain other issues, but I can't really point you to like one single resource that would is really directed towards caregivers. But HERA would certainly be interested in looking into that or collaborating on something like that. In general, I do like to point people, as I have in this presentation, to the Consumer Financial Protection Bureau website, the Federal Trade Commission website. There are a lot of good materials there on banking and credit issues and budgeting. I think the Mission Asset Fund, I'm not sure the geographic scope of their services, but they'd also do financial education. We don't like to plug any particular bank or credit union, but I can say that we have collaborated with the Self-Help Federal Credit Union in the past on doing consumer education, and so you might be able to find a credit union or nonprofit organization like that to be able to provide at least some overview of things that might be helpful for that particular group of people.
Yeah, we've got some partnering agencies that have also collaborated with self-help credit unions, so that's great. Then there's someone asking about lending, how a lending circle works.
Yeah, so I don't have personal experience with that particular type of arrangement. It's the Mission Asset Fund is really the organization that's well known for organizing those. But the basic concept, I'm not sure I could elaborate more than I already have about a lending circle. But basically, a group of people is organized between, I couldn't tell you the numbers, it might be between 20 and 50 people. And everybody, to be a member of that lending circle has to contribute a certain amount of money. I don't have a clear sense of how much exactly that would be, whether it's $100 or $500 or more, but they each contribute a certain amount. And the understanding is that there's certain time intervals, whether they be monthly or quarterly, during which a member or maybe certain group subset of members of the lending circle is allowed to take out a certain amount of those funds for their household use or maybe to start a new business or something. And so it's a way to kind of pull together money for the common good of that group, and then allow people at certain intervals to draw from that for their own use. And again, I don't know the ins and outs of it. I think there must be some mechanism that ensures that there are regular contributions to that. There might be some commitment that after you use the funds, if you're able to generate more income from the use of those funds, that you might have to give more money back. But that's as much as I understand, really. The Mission Asset Fund would be.
Yeah, I put a link in the chat to the Mission Asset Fund Lending Circle's information. So there is that in the chat. People can copy that and take a look. And that is all the questions we have right now.
Those are great questions. We're about halfway through, so why don't we go on to the next segment here?
Sounds good.
All right. So getting back to saving, kind of just some ways, some strategies for saving might, for people that are really financially distressed, these might be difficult, but very basic, but try to put some of the money from your paycheck into a savings account each month, whether it be $10, $50. Try to tuck that away before your money goes out the door paying bills, if possible. Obviously, if you have to pay essential things like rent and utilities, transportation, that's not possible. But sometimes we kind of let the savings aspect of our finances go by the wayside because we're so focused on making those essential payments. And so this is just a reminder to take a pause when you get your paycheck and try to pay yourself first. It could be through savings account. It could be through buying an investment, contributing to a retirement account. You can open up your own retirement account if your employer doesn't offer one with a bank, such as a Roth IRA, or with an investment organization like Fidelity or Vanguard. Here's a program that I just learned about working at HERA a few years ago. It's called the Earn Starter Savings Program, and it's through a nonprofit that is escaping me right now, but I can certainly find more information and send that later. But you link a savings account of your choice to this program, and you save at least $20 each month for 6 months. And each time you reach your goal, you're going to get $10 in rewards, because this is a nonprofit program that wants to encourage people to save. You just have to be over 18 and have or be able to open a savings account, and you have to have online access to the savings account, and then you link it with this program. And it's a good way, particularly for very low-income people. $60 in 6 months can make a big difference. It's just a way to encourage people to start saving. This website is a website that we actually started at HERA called Money Happy, and we try to provide options, or at least provide links or short descriptions of potential options for people that need money to pay things, whether it be credit card, medical bills, or mortgage, to point people to reliable, non-predatory sources of credit, and also to post tips on how to manage your finances. And it's called Money Happy, and there's the link. And I think we try to organize it on a county by county basis so that it's localized information for people. Doesn't necessarily have information for all counties in California, but we're working on that. So just something to point out. You can, click on your different cash needs for the month if you're scrambling to pay those, and see what options are out there. In terms of whether it be credit unions or other options. Okay, so kind of turning now to exactly what is credit. I've talked about this before, but credit basically is borrowed money that you have to repay, usually with interest, like a credit card or a loan or a mortgage. It's important to kind of make the distinction between credit and banking and checking and savings accounts, because you don't improve your credit history with bank accounts. A lot of people don't understand that. They may have never had a credit card, but they've always been in good standing with their checking and savings account. They don't understand why their credit score is low. It's because you have to establish credit. You have to actually borrow money and pay that back on a timely basis, and have a recorded history of that for your credit score to go up. And so before we get into more of the credit reporting and credit score issues, just wanted to talk about just like, when you're shopping for different banks and looking at what fees they charge, it's good to compare prices for loans and financing as well. Don't just go with the first lender, first auto lender. You go to buy a car, they always push you towards their auto lender. You don't necessarily have to go with that. You go with your credit union. You could shop around. Same with buying a house, or getting a credit card. It's good to compare offers from different sources, different finance companies. And it's good to, we talked about that Truth in Lending Act box. I think we're going to talk about it more. But it's good to know what amount are you going to have to pay for that money, because it always comes with a price. And so, and that price might be negotiable. Like if you're trying to buy a car and you're trying to finance it, they might start out with a high interest rate or annual percentage rate, which is just the interest rate converted to how much percent of the loan you're paying in the course of a year. That might be negotiable. The length of the credit agreement might be negotiable. You're going to end up, your monthly payments will be more if you're paying something over a shorter amount of time than if you could spread it out over more years. You have to know how much you can afford to pay, right? And looking at your budget, you're going to add something else to your budget. Can you afford the monthly payments? And then we always, gloss over the fine print and the 10 pages of like 10-point font or less contract terms. But it's good to verify those and make sure that the key points that you've been told are in there, that the interest rate is what you've been told, the monthly payments are what you've been told, the finance charge, the price of the money that you're borrowing, the amount of time you have to pay it back. Those are kind of key things you always want to check. And again, some of those contracts can be very convoluted, a lot of fine print. Places like HERA, reliable nonprofits, we're here to help, and we're happy to look at anybody's contract terms before they sign to make sure that they're getting the deal that they asked for. So California Civil Code Section 1632 requires that a copy of a translation of a contract that's negotiated in one of California's 5 major second languages has to be provided before the consumer signs the contract. So I put Spanish up there because that's what we see most, but it also includes Chinese, Tagalog, Vietnamese, or Korean. If that contract is negotiated without using the person's own interpreter, in other words, like if you're buying a car and it's negotiated by a Spanish-speaking salesperson with you in Spanish, they have to provide you a Spanish language copy of that contract before you sign it. And if they don't, you have the right to cancel that contract. So it applies for any of these 5 languages. And we see that more than you would think. People coming in, they negotiated it in one language, usually Spanish. They were told, different interest rate, different terms than appears in the contract. And we look at the contract and it's in English. They didn't understand it. They couldn't read it. And they were basically conned into signing the contract. And so we try to help them deal with that, cancel it, or make some sort of arrangement for that. So in order to avoid the higher cost loans, and we're talking now about more general, could be credit cards or could be other types of loans beyond the loans, the payday loans and small dollar loans we talked about before. It's important to look at this TILA box that I talked about, because it will tell you the true amount of how much something's going to cost you. One of the key things, how much you're borrowing. You might be borrowing $20,000, but how much are the total of your payments when you're making monthly payments that are both for the principal and the interest? If you go to one place and the $20,000 loan has a total payments that total $40,000, that's going to be better than a $20,000 loan, with a higher interest rate where your total payments are $60,000. Even better, though, if you can get a $20,000 loan and only pay like 25,000 or less. So the total payments box is really key. The amount financed, that's just the amount of credit that you're getting. That you should know that should be consistent with what you were told. And the finance charge is really, the amount of interest you're paying. And then of course your APR is your annual interest rate. So just a kind of a comparison here. So it's same, the loan in these two examples is $10,000. But there's a big difference on if you charge 5% annual interest, your total payments are only $11,322. Whereas if you charge 20%, your annual payments are almost $16,000. So that's kind of why this is a key piece of information. All right, going to turn now to credit reporting. Credit reports, I think, as we all know, can impact our financial options. Banks and lenders will use this to decide whether to make a loan or what interest rate they give you. The lower your credit score, the higher the interest rate, because they're worried about you not being able to pay it back, and they're going to charge you more if they feel they're taking more of a risk. Rental housing, landlords will rely on credit reports, usually tenant screening reports and credit reports, to decide if they're going to rent an apartment to you. So that can have an impact as well. Insurance companies will use it to determine whether to give you coverage and rates that they're going to charge. And in some cases, employers will use that, but it's California law really limits the types of employers that can do that. I'm not up on the current state of the law, but that labor code section tells us what it is. I think it's usually related to people that are working in the financial industry and public employers and law enforcement. But if they do ask for a copy of your credit report to make that employment decision, they have to provide you a copy. So credit is very important, and a good credit report can open up more opportunities. So we're going to talk now about things people can do to maximize their good credit. So one key thing that we ask everybody to do who wants to improve their credit is to check your credit report. There are three major credit bureaus, Equifax, Experian, and TransUnion, and everybody in the United States who's 18 or over probably has a credit report with all three of them. They just don't know, many people don't know about it. It will show their names and addresses and phone numbers, previous employers, any public records that come up in terms of litigation judgments or bankruptcies or federal and state tax liens, any accounts that went to collection agencies, and then credit accounts. And again, to distinguish from bank accounts, these are not checking and savings accounts. These are credit where you actually are open to credit line or are using another lender's money to spend and then pay back. And then it has inquiries, which basically means when you apply for credit and a lender wants to see your credit history, that inquiry that they made to look at your credit history will show up. And if you get a lot of inquiries within a short period of time, that's not a good thing, because it makes lenders think that you're applying for credit and not being able to get it. And so it drops your credit score because of that. Didn't say this before, but your credit report is not your credit score. Each of those three major credit bureaus does generate a score. That's a separate piece of information. They will charge you for that, but you can get your credit report free. And we'll talk about more about that later. But right now, under the Federal CARES Act, there was an amendment to the Fair Credit Reporting Act that says until April of next year, you can actually get your credit report free once a week at the annualcreditreport.com website. I'll talk more about that because you have to be very careful with that website. There are a lot of copycats out there. You want to go to the right website. But that is a good thing that happened recently for people to be able to check their credit. So here's the different types of accounts that are reported on your credit report. In the left-hand column, you see, things we've talked about: credit cards, mortgage loans, student loans, auto loans, collections, debt judgments, and some personal loans. Things that are not reported that will not affect your credit one way or the other. Rental payments are not going to show up. Public utility payments will not show up. Payments with your debit card, your ATM card, that's not going to show up. Payments with pre-credit cards will not show up either. Secured credit cards will, because even though in that arrangement you're using your own money at first, it is considered a credit card and it will build your credit. For tenant screening reports, evictions will show up, although rent payments don't. You have rights and protections related to your credit report. As it says here, since the COVID-19 crisis, the CARES Act does allow you to check once a week until April 2021. Here is the exact link you need to go to. It has to be this HTTPS, because that's a secured website, www.annualcreditreport.com. It can also be ordered by phone, or if you want to do it by mail, you can go to the website and print the form out. You can also, I think the Consumer Financial Protection Bureau website and the Federal Trade Commission website also have links to this website, to the annualcreditreport.com. That is the only website and company that's authorized by federal law to give you access to your 3 major credit bureau reports for free. And usually it's once a year, but as I said, due to the COVID crisis, the CARES Act is allowing it once per week. And it's something for people to check. And the reason is, one of the main reasons, even if we don't suspect it, there could be identity theft, there could be accounts created that we don't even know about in our names. And there could be errors where you actually did pay off an account and it's showing it as unpaid. Or there might be this is common with a lot of Latinos that have similar names, where you're getting, it's called a mixed file, where you're getting someone else's information on your credit file because you have the same name. And so those are important things to correct. And you have the right to have those errors corrected under the Fair Credit Reporting Act. Here's all the information here. If you dispute information and you make a complaint to the Credit Reporting Bureau, they have to conduct a reasonable investigation to see if the information is in fact inaccurate. They have to show on the report that you're disputing the account or the information. And if they find it to be inaccurate or incomplete, or they can't verify the information, they have to delete it. Another thing that's happened as a result of COVID-19 and the CARES Act is that a lot of people have lost their jobs, millions of people, and creditors are making accommodations. In many cases, they're given forbearance where you don't have the obligation to pay, and they're not going to consider you in default during the forbearance period. They'll offer reduced payments, and these things are called accommodations. And what the CARES Act provides in terms of credit reporting is that if the consumer was current before I believe the national emergency was declared in March of this year, and then the consumer goes into forbearance or is allowed to make a lower monthly payment, the creditor still has to report that account as current during this time period. And if they make the accommodation, even if the account was delinquent, the creditor is not permitted to report the delinquency as long as the forbearance is in play or the reduced modified payment is in play. In effect. And so these are things we're not sure if the creditors are actually following this. They should be, but you want to check your credit report and make sure. And if they're not, this is something else that you can ask to be corrected. One thing to mention here is that you don't just want to report the errors or inaccuracies to the credit bureaus. If it's with a particular credit card or lender, you want to report it to the lender as well and explain why it's inaccurate and ask them to correct it as well. You want to, so there's basically two different letters that would go out. You know, some of this you can do online with like Experian, TransUnion, Equifax, but I always think it's better to send a letter that's signed, send it by certified mail, and keep the receipt and keep a copy of the signed letter, because down the line, you know, if it's a serious error and they're not correcting it, you have the right to bring an action in court. And there are attorneys that will do that because they can get attorney's fees awarded if they prevail. So there's an incentive for private enforcement of the Fair Credit Reporting Act. Just in general, most negative account information can only be reported for 7 years. So that's 7 years from the date of the default or the date of the first missed payment. A bankruptcy, though, can be reported for 10 years. So if you review your credit report and you see, you know, like you see an account from 2010 and that was when you defaulted and it's still showing up in 2020, then you need to write a dispute letter or dispute it with the credit bureau that's reporting it, as well as the creditor, the credit card or whatever lender, because that should not be on there. We recently had a person who had a judgment reported, an eviction judgment that was from 2010 and it was still showing up in 2020. It resulted in him being denied rental housing, and that was a clear violation of the Federal Credit Reporting Act, and we were able to get the tenant screening credit reporter to take that off and give him some compensation for doing that. Eventually, he did find housing because the other place he applied to did not use a credit reporting agency that showed that judgment, and so he was able to get rental housing. So if you haven't looked at your credit report before, this is kind of an example of what one account might look like. It has information, you know, it'll show you who the creditor is, what the account number is. Usually it's not the full account number, some of it's blocked off. It'll show you the current balance, what the pay status is, is it current, on time, or is it 30 days past due, 60 days past due, or 90 days past due, or is it charged off? And people get confused with the term charged off. That does not mean that you've been forgiven of the debt. That means that the creditors decided they don't want to try to collect on the account anymore, and they get a tax write-off for charging off the account. But usually what happens is they sell or send the account to a debt collector, and then it appears on your report as a debt collection account, and that debt collector has the right to try to collect on the debt, as long as it's, well, they can collect forever, but they can only take you to court if it's 4 years after the default, or within 4 years after the default. If it's more than 4 years after the when you became past due, then they're past the statute of limitations in California. But kind of got sidetracked. Back to the credit reporting. It'll tell you, you know, how much is past due and other information, but it usually goes month by month here, as you can see. So you kind of, I look at the rating for each of these months. You see these okays, that's what you want to see in a credit report. The more of these okays, you know, month by month, the higher your credit score, basically. That's kind of the simplest way of thinking about it. You're going to have all your credit accounts, whether it be 1 or 20. You know, negative information could appear for the past 7 years. And you're going to, if you made your payment on time, month by month, you're going to have a whole bunch of okays. And that's all good for you. But once you start getting these 30-day past due, 60-day past due, 90-day past due, that's what starts hurting your score. And so you want to look at that and make sure it's accurate. And if it's not, you want to correct that. I guess other things to look at. I mean, you know, did you have an account with this creditor? Did this person have a little town bank account? That's another thing to look for. are the dates right? Was it opened in 2013? We had another client who he was incarcerated for 10 years, and he comes out, and he's trying to he got a job, he's trying to get his life back together, and he pulls his credit report, and there are like 3 credit accounts that were all open in 2015 when he was incarcerated. So there's no way you can't open an account when you're in prison. So it was clear identity theft. And so, one of the things, I mean, obviously he knew he didn't have the account, but we looked at who it was. It was Discover Bank. We looked at the date it was open, 2015. And so all this information allowed us to dispute it and put in writing, proof that he was incarcerated. Ask the Discover credit card, well, show us information that he had the account. And when they showed us the information, it was opened up by someone down in Southern California, and this person had only lived in the Bay Area his whole life. So we were, those are kind of the things to look for in terms of accuracy. This is just a little more detail on annualcreditreport.com. I keep emphasizing it has to be annualcreditreport.com. This is what it looks like. I mean, the picture might be different, but this is kind of the general logo. You don't want copycat websites like freecreditreport.com or free annual report. It has to be exactly this. Otherwise, it could be a scam, or they could ask for you to pay for the credit report. This website, if we're allowed 1 free credit report from each of the 3 credit bureaus once per year. And now, like I said, it's once per week until April. And here on the right side of the screen, this is the form you would use to request by mail. Now, sometimes what happens, I've walked through clients, helping them enter their information. You basically click through on the secure website and you put in, name, social security number, address, if you've moved in the past 2 years, your prior address. And then for each of these credit bureaus, you go one by one, like start with TransUnion. TransUnion will ask you like 2 or 3 questions to verify that you are you. So it'll say, have you ever lived at any one of these addresses, A, B, C, D? Have you ever had an account with any of these lenders, A, B, C, D? And if you get it wrong, it's not going to give you access because it's trying to protect your identity. And that's when you would have to print out this form and request it by mail, along usually with like a copy of your driver's license. It'll tell you what else you need. It might be a copy of your driver's license, a utility bill. Well, sometimes people get it wrong because they can't remember, or they just made a mistake in the answer they put. But other times, the reason why they can't get it right, the verifying questions, is because they are a victim of identity theft. And someone did get an auto loan in their name with Ford Motor Credit Company, and they just don't know about it. And that's why they got the answer wrong. So, it's, again, I can't emphasize enough how important it is for people to check their credit reports. And this is an easy way to do it, particularly during this time. Here's a little more detail on disputing errors that you find on your credit report. So, step 1 is to tell the credit reporting agency some tips. Just, you want to send it by certified mail, preferably with return receipt. Include copies of documents that support your position, like if you didn't live at a certain address and it's showing, you did. You could show proof of your address, copy your driver's license. You have to identify specifically what you're disputing, and you should provide a copy of the page of the credit report, that where you believe the information is wrong, and you can circle that or you can highlight it. And then they have basically 30 days to investigate and respond. They usually take longer. They ask for an extension, and they can. That's the way it goes. And then step 2, you want to provide the information to the furnisher of the account information. So it could be the credit card or the lender or the debt collection agency, and you want to give them the same information. Send them a copy of what you're disputing, identifying it, explaining why it's wrong, and sending any information that supports your position that it's wrong. Sometimes, how do you, if someone opened up an account in your name with Discover Bank, how do you prove that's wrong? Sometimes you don't have any supporting information, but you have to dispute it because it wasn't yours, and you tell them that you're a victim of identity theft. There are some other things for identity theft that we'll get into, such as submitting a police report and the Federal Trade Commission identity theft report. Here's a sample letter, and I think you could find this on the Federal Trade Commission website. But it just tells you the words you need to say when you're disputing this. I mean, there's no magic incantation. You just need to tell them, the credit reporting bureau or the credit card agency, that you're disputing the debt, and give copies of the disputed information and any supporting documents. So this is more something that you can show clients or use yourself as a template. So identity theft's a little more involved. If someone believes they're a victim of identity theft, they should put a fraud alert with the credit reporting agencies. So Experian, TransUnion, Equifax, report to them that you're a victim of identity theft. If you just Google any of those, you'll get the information. You can call it in. You can send a letter. Probably best to call it in. Technically, if you tell one of the bureaus, they're supposed to tell the other two themselves, but you might not want to depend on them to do that. And that'll stay on your report for 90 days. And what that tells the credit reporting agencies is that if anybody tries to open an account, whether you or anybody else, if that alert's there, the credit card that's trying to open the account will see the alert, and hopefully they won't open the account. But more importantly, you'll be alerted yourself that someone's trying to open an account in your name, and you'll be asked to verify whether it was you or not. When you make the fraud alert, you get free access to your credit reports. So you can do that. I mean, right now you're getting them every week anyways, but that's another thing that normally happens. And then you should create an identity theft report. So here's a link to the FTC website. It's a very user-friendly website. I'm going to show you sort of a screenshot of it in a minute. It just walks you through, like, what are the accounts that you believe were created by identity theft? Why do you believe that? How much money is involved? Do you have an idea who it was or not? And it generates a report that basically you print out and you sign under oath, basically saying, yes, this happened to me. I'm a victim of identity theft for this specific account or these specific accounts. And then you take that to the police department. You don't necessarily, you could file a police report independently without doing that, but that's one way to just help bolster your claim with the police. A lot of police departments these days, you can do an identity theft report online by a similar process. You just check the number of boxes and fill out the information. And then you get a draft copy emailed to you. And then once they review it and approve it, you get sort of a stamped copy. And when you have these two documents, the FTC identity theft affidavit and the police report, that's what you send with your dispute letter to the credit bureaus and to the credit card or accounts that you believe were created or used due to identity theft. And that triggers additional obligations on those organizations or companies to investigate and determine whether they see identity theft going on. And during that time, they cannot collect on the consumer for those accounts. As it says at the bottom, you should always save copies and letters and record the dates of these, because this may come up. You may have to go to court or seek help from the government, and you want to have proof that you made these complaints. So after being notified of identity theft, the credit reporting agencies have to block that reporting until the investigation is conducted. The debt collectors have to cease the collection activities, And you have the right to go to court if, oh, I'm sorry. You do have the right to go to court if they won't, if you believe it was identity theft, you gave them notice and they didn't correct it. But you also have the right to bring a cross complaint if you're being sued by the credit card company that you believe was created by identity theft. You can actually cross complain against that credit card company for not conducting the investigation and closing the account if in fact it was created through identity theft. So here's that FTC website. It's identitytheft.gov. It's really user friendly. I've helped clients go through this, and most clients can do it themselves, but sometimes, you know, it's good to go through it with the client if they need help. But you just click on the Get Started button, and it just walks you right through with all the information you need. You want to have with you a copy of the credit report that you think shows the identity theft, so you can put that information in this. You want to have any information available about who might have done this. Usually you don't know. You want to have information available about why you think it was identity theft. And then you just click through and fill out the forms, and then it creates this affidavit, which is a sworn statement for you to print out and sign. And then that's your evidence of identity theft that you send with your dispute letters. And you can, not necessary, but you can show it to the police if you're having trouble having them make a police report. The other thing that you'll get from this is, you'll see at the bottom, it says there's a recovery plan. So this will actually generate a list of steps for you to take as well. Many of which I've talked about, like placing a fraud alert on your credit report, making a police report, and things of that nature.
We have about 5 more minutes.
Okay. So I'm going to whiz through a few things here. I don't think they're as crucial. I think we've covered a lot of the most important information. But this slide just gives you they're kind of two different credit scores that the credit reporting agencies use, and it gives you a sense of what the what the credit score is based on. We don't actually know the exact criteria because it's proprietary. We don't have public access to it, but we have a sense of it. If you look on Experian or Equifax or TransUnion, they'll explain it to you in more detail as well. But your payment history, you could see, is like the biggest consideration. Are you making on-time payments or falling behind? That's the biggest impact. Utilization is kind of like, how often do you use credit? If you use credit a lot and pay it off on time, that's really good. And the amounts owed, or your balances, can be a big impact as well. If you don't have a lot of credit, your score might be lower. If you have more accounts, it might be higher. It should be higher. And if your balances, the outstanding balance is more, like you're only making minimum payments, that's going to lower your credit score. Whereas if you're paying everything off on time every month, it's going to make it higher. You can see the types of credit, like if you have different types, like if you have a mortgage, auto loan, and credit cards, that might improve your score whereas your score might be a little lower if you only have credit cards. And then the length of credit history is a big thing. Some people like to close out the credit cards they're not using, but that can, you close it out and it's off your report at some point, and then you lose that length of credit history, because they look at your average average credit account. If your average credit account is like 15 years, you're going to have a higher score than if your average credit account length is only like 3 years. So sometimes closing out those old accounts that you're not using might not be the best idea if you're trying to improve your credit score. One strategy is to keep them open, but just use them once in a while. Even though you might want to be using the credit card that gives you like the airline points or the money back. If you have an older credit card that's just sitting there, you might just want to use it to make a payment on something you're going to make anyways, like your cable bill or your cell phone bill. This is kind of a whole laundry list of strategies to take. We kind of went over a lot of these already to improve your credit. Review your credit report and dispute errors. There are credit building products like unsecured credit cards. There are credit building loans that you can find. Self-help credit union, as I mentioned before, they have these. Other credit unions are good about having these. Pay your bills on time is a key amount. Keep the amount of credit that you use low. Try to use less than 30% of your total available credit. If you're using more than that, they kind of ding you on your credit score. Like I said, try to keep some of your unused credit card accounts open if you can. That's helpful. Sometimes we want to close them out because that's also kind of leaves it open for identity theft. But you know, it's like I said, it's kind of a trade-off. If you already have a good credit score, it's not going to hurt you that much to close it. But if you have a credit card you had for 15 years, it's probably one you want to hang on to, even if you're not using it. So there's some other tips here. People that have medical debt, you know, sometimes we don't have medical insurance and we'll get taken to the county emergency room and later find out that you know, they gave us some test, a blood test or something, or maybe they did an x-ray and then we're hit with a $10,000 bill. Well, that's a lot of these hospitals don't talk about charity care and financial assistance available to low and moderate income clients or people without insurance, and they're supposed to by law if they're a nonprofit hospital or government hospital. And so that's something to look out for in terms of medical debt is, was the person provided information in the option to apply for financial assistance. And sometimes you can get those bills lowered that way, or that can be a defense to a debt collection lawsuit.
So we are at time. There are a few people that might need to leave, and I just want to honor that. We do have a few questions. If you do need to leave us, thank you so much for joining us. And we do want to remind you to complete the evaluation that you'll be getting and to get your certificate. We will be also sending a link to this training and to the handouts via email. So yeah, thank you so much. And as soon as you're done there, Joe, we'll get to a couple of the questions.
Okay, I apologize for running a little bit over. I'm going to whiz through the last two here. Just some information about protecting your credit during the pandemic. Talk to your lenders or creditors or have your clients do so. You can make arrangements. Like I said, if there are accommodations such as forbearance or lower payments, that will also help minimize impact on their credit report, because they have to report their credit as current if those arrangements are made during the pandemic. There are forbearances in place for federal student loan payments until December 31st. And federally backed mortgages are also, not all mortgages, or home loans, but people with federally backed, meaning with Fannie Mae, Freddie Mac, FHA, VA, and USDA. There are some good options for forbearance, meaning you don't have to make your payment during a certain amount of time. And the credit reporting, a little more detail on this last slide, you know, on how the CARES Act is providing some protections against negative credit reporting for arrangements that are made as a result of the pandemic. So I'm going to close it there, take some questions, and then, yeah.
Yeah, there are a few questions. One is, let's see, back to the the information you were talking about, contracts and the code around the contracts and interpretation requirements. Yeah. What types of contracts does this code cover? Is it all kinds of contracts?
It covers most consumer contracts. Okay. There are some that have a little bit of different requirements. So home improvement contracts are actually covered by a different code called the Home Sales Solicitations Act, but the requirement's basically the same. Auto loans might be covered by a different, I think auto loans have their specific language translation requirement, but I think Civil Code 1632 also applies to auto loans. Mortgages, I think, have a slightly different requirement, but it's pretty similar. So again, there are some exceptions to this. But I think that the default position should be that a translation should be required. And if someone is in that situation where they signed a contract in English when it was negotiated in another language, and now the terms appear different, they can certainly come to HERA and we can review it and we can nail down, whether 1632 applies or if it's a different provision. But really, almost all contracts have this in California, have this language translation requirement.
And what is your language capacity at HERA in terms of monolingual immigrant folks?
We have Spanish language capacity. I speak Spanish. We have at least 3 other people on staff that speak Spanish. We have a Korean speaker on staff. And we also, we try to accommodate anybody from any language. And we have a translation service or an interpretation service that we get on the phone. So if we're going to talk to somebody, I recently spoke to an Arabic speaking client, and we contract with this interpretation service. And I had a good conversation with him that was interpreted by an
phone line. That's yes. Great. And another question is about someone with an ITIN. How can they check their credit score? Do they just use that number, or?
That's a good question. And
should I know they call HERA?
Probably the best thing to do is to call HERA. It may or may not show up under the ITIN. I think it might be limited to Social Security numbers, but I'm not completely sure about that. So they can certainly try with their ITIN and see what happens. But if they're having trouble or if something seems wrong, they can call HERA and we can look further into it.
Great. And then you did give us those reliable sources to get one's credit checked. And then there was another one about how long dings on one credit stay. And you told us, I think it was 7 years and then a bankruptcy is 10 years. Is that right?
That's right. That's okay. Right.
Great, great. Well, thank you so much, Joe. We really appreciate you being here, and we thank everybody for joining us today. And this was a lot of comments from people about this being great information, really helpful information. And people that are still here, feel free, once we send you this link, give it to your clients if they want to hear this information. It might be helpful to them as well. We're there. I put we'll send you the link to the training, and also you can just Google YouTube First 5 Alameda County and you'll find our trainings there. So thank you very much everyone for attending.